Corporate America is on a borrowing binge. High-yield bonds carry a higher risk, as we know, of default than most bonds issued by corporations, aka junk bonds, and at least $382 billion have been issued by firms from Coinbase to Crocs this year alone. That's almost $46 billion more than 2019. I compared to 2019 because that was pre-pandemic. But should investors be worried about companies racking up debt?
With all the growth in junk bonds, you may look at it and say, be concerned, but actually the quality of the high yield market over the last 10 years has actually improved.
As has the default rate, falling sharply since the pandemic era peak, as seen in this graph on the right-hand side. Companies are rushing to take advantage of cheap rates and refinance their loans. There are negative catalysts, externalities, like the Fed tapering its bond program, higher inflation, and a slowing economy. Even JP Morgan recently lowered its forecast for U.S. GDP because of the Delta variant, as well as supply chain issues, to 5% that you can see on your screen. And if you're wondering, to invest in actual junk bonds, you do need a broker. But I picked a few for you: HYG, JNK, and USHY. These are all junk bond ETFs. You can see that since the pandemic low, they have brought up double digits in returns, although still sharply below the S&P 500 returns during that exact same time. And as we've all seen with Evergrande, corporate debt can seem like a great investment until it's not. And investors need to decide if these negative catalysts are just temporary headwinds or a warning that the debt binge bubble could be set to pop.
Shepard Smith here. Thanks for watching CNBC on YouTube.